Hello everyone, welcome to Master's Teach. And today we are going to discuss very long session Managerial Economics. Let us see with the paper like Unit 1, okay, where we are going to learn nature of economics. So, see, the definition says that application of economic theory and methodology to business decision making and forward planning. So, the key characteristics of uh, managerial economics is that it is the microeconomics in nature. Okay, then it comes to the prescriptive rather than descriptive. So, my managerial economics uses quantitative and qualitative tools, focus on practical problem solving. So, here in economics perspective, there are four things are there: microeconomics, macroeconomics, then positive economics, and normative economics. So, in the question, if they ask what is the economic perspectives, you have to mention microeconomics link. That is, it's focus on individual firms and behavior, and it says about the demand and supply analysis, then pricing strategies and resource allocation decision. Then second one, macroeconomics, which consider the broader economic factors like inflation, GDP growth, then interest rates and government policies affecting businesses. Then positive economics, it's deal with what is, so objective analysis of economic phenomena based on facts and data. So positive economics says that, so it is based on real facts and data, whereas nominal economics, it says what ought to be, value judgment and policy recommendation for better decision making. So make sure that economics perspective you have to write microeconomics link, macroeconomic links, then positive economics, then normative economics. So scope of managerial economics, say one is demand analysis, cost analysis, production analysis, pricing decisions, and profit management, capital budgeting. So when they are asking about the what's the scope of managerial economics, you have to write demand analysis. So it forecasts the consumer's demand and understand market dynamics. Then cost analysis. So it says about the like production cost and how to utilize the resource. Okay. Then production analysis, which says about the maximum using of production level and efficiency measure. Whereas pricing decisions, so it says about the competitive prices to maximize profitability and market share. Then profit management, so which is the like how to get maximum returns, okay, with the sustainable growth. Then capital budgeting, it says about the long term investment opportunities and resources allocation. Then significance in business, so why this managerial business economics is required for the decision making. For example, business has to choose the best decisions, for that this is required. Then risk management, in order to help and identity and also examining the uncertain things, so there is a risk management, that is the reason we use the business economics. Then policy formulation, so which guides the development of effective business policies aligned with the market condition. Then strategic planning, which includes long term vision and competitive positioning in dynamic markets. So the significance of business is that decision making, risk management, policy formulation and strategic planning. And then tools and techniques of analysis, when they are asking what is the tools used for the economics, micro like business economics, you have to say that marginal analysis, incremental analysis, opportunity costs. Then it comes to the uh, discontinuing uh, principles, then econometric methods. Okay, here The thing is that tools and techniques of analysis, marginal analysis. So it affects the with the small change in variables. That means it's going to be effect in the long run. Okay. So adding one more unit of production. Then incremental analysis. So it says about the what is the impact of managerial decisions if they are using any alternative. Okay, like it focus on cost and revenue. Then opportunity cost, so consider the value of the next best alternative foregone. Okay, so principles for resource allocation and decisions. Then discounting principle, so adjusting the future cash flows to present value for investment evaluation and time based decision. Then economic methods, so uses the statistical techniques and mathematical model for costing and hypothesis testing in businesses. Then theory of firm, so you have to write different types of theories of firm. Okay, one is profit maximization. This is also called as traditional theory. So firms or company aims to get the maximum price difference between the total revenue and total cost. MR is equal to MC. That is a total revenue equal to total cost. Then sales maximization. This is also called as Baumol theory. So managers focus on revenue growth subject to minimum profit and constraint for market dominance. Then managerial utility. So Williamson theory. So manager maximize their own satisfaction through staff eliminates and discriminatory investments. So these are the theories of firm. One is profit maximization, sales maximization, then managerial utilization. So firm objectives and alternatives. So what is the aims of or objectives of the firm or a company? One is profit maximization. The second one is the wealth maximization. Third one is the growth maximization. Sixth one is the fourth one is the social responsibility. What is profit maximization? Getting the more profits per unit, which is what they invested. Okay, then wealth maximization, increasing the shareholders value. That is the thing. Growth maximization means expanding the market share and revenue and organization size. Then social responsibility, which is balancing profit with the ethical practices. So we already discussed about the uh, corporate social responsibility, CSR, that is related one. Okay, then functions of economics. What is the functions of managerial economist? Okay, as the economist, they see forecasting the demand. So what is the future demand? What is the future like it says on the basis of statistical thing. Then cost control, controlling the cost, that is the main thing. And price policy, that means developing the competitive pricing strategies based on marketing condition. Then market analysis, study market trends, consumer behavior, competitive landscape and strategic planning. Then investment decisions, so evaluating capital projects and recommending optimal resource for allocation for long term growth. So these are the functions of managerial economist. So in modern way, so how the decisions are influenced? One is due to information technology, second one is the economic factors. So information technology, how we can impact? So they'll get the big data analytics, so they can processing the huge data, so that they will get the consumer insights and market pattern. AI is forecasting, so machine learning algorithm improve the demand prediction accuracy. ERP system, so it is the integrated platform for real time business intelligence and operations. Then digital market analysis, social media analytic and online consumer behavior tracking. Then economic factors, it like influencing interest rates, government policies, competition, and consumer behavior. These are affects the decision making. So this is a small presentation. Okay. Uh, Kindly wait. I will check with the second unit. Kindly be online. Yeah, I'm opening the second one, second unit. Okay. Yeah. The second unit is that, okay, it says about the managerial economics and demand analysis. What is that? We discuss managerial economics and demand analysis. I hope you are able to see the thing. Okay. So here, what is the managerial economics and demand analysis? So demands are two types. One is individual demand and market demand. So demand means what? Demand refers to the quantity of a good or services that consumer willing to and able to purchase at various prices during the specific time period. So that means whether consumer uh, like they is willing to purchase, is able to purchase in a particular price during the specific period, that is called as demand. So individual demand, quantity demand by the single customer, whereas market demand, total demand from all the customers in the market, that is called as total demand for all the customers in the market. Then what decides the demands and significances? One is prices of the product, and second one is the consumer income, third one is the consumer preference, fourth one is the uh, related goods price. Okay. Fifth one is the here future expectation, and sixth one is the advertising. So these are the what is the determinants of demand and significance. You have to write all these six. Okay. Then demands function. Okay. So what is the function of the demand? The demand function expresses the relationship between quantity and demand and its determinant mathematically. One is general form, okay, and linear demand function. What is the general form? The formula is QD equal to F into PYTA, PS and PCE. The whereas P for price, Y for income, T for taste, A for advertising, PS for substitute, and PC for complement price, then E for expectation. This is a general form. Whereas linear demand function, so QD equal to quantity demand equal to A minus BP. Or example, quantity demanded equal to 100 by 2P. Okay, what is 2P? It is a two price of the two products. Okay, so here this is the thing. Just write the general form and linear demand function. Then loss of demand. Okay, what is the law of demand? So it says that other factors remaining the constant, as prices income, quantity demanded decreases, vice versa. What is this? If the price is low, the quantity is purchased more. If the price is high, the lower will be the quantity demanded. This is the thing. And the key assumption is that the consumer income should be remain constant, the prices of related goods unchanged, then consumer taste remain stable, no expectation for the future price changes, exception like Jiffin goods, okay, Veblen goods, then necessity during the emergency speculative market. These are the law of demand. Just remember, low price, high quantity demand, high price, low quantity demand. Okay. Elasticity of demand. Okay. How many types of elasticity of demand? So elasticity measures the response of quantity demanded to change the determinant. One is price elasticity, income elasticity, and cross elasticity. I'm going to post in the description. Just download the master's teach app where you can get the MBA semester paper folder where you can download these and you can study. Then degrees of price elasticity. Just write what is the price elasticity. One is perfect elasticity, another one is elasticity, third one is unit elasticity, inelasticity, and perfect elasticity. So these are the degrees of elasticity. Then supply analysis and functions. So if the price is here, the determination of supply, price of the product, cost of the product, technology and production method, government policies and taxes, number of sellers in market, and future price expectation. So these are the supply analysis and functions. Okay, just go through this particular formula. It will give good marks. Then demand forecasting techniques, how the demand can be forecasted. Okay, what is going to be happen in the future. One is survey method. In survey method, consumer survey, expert opinions, and market experiment. Whereas statistical method, so trend analysis, regression, time series. Then barometric techniques, it is a leading indicators and economic index. Okay, so what is the key takeaways and applications? We learned about the pricing strategy, production planning, and market strategy, policy, decision making. This is about the second unit. Kindly be online. I'll give the third unit also. It is a quick revision. Okay, kindly be online. I'm giving the quick revision for this particular economic subject, so that you are not going to lose anything. Just listen the class whether you are traveling or just simply note down important point that will be helping you. Cost and product analysis, this is the third unit. Okay, cost and product analysis. Okay, don't worry, if you download Masters Teach app, you are going to have it free of cost, this particular PPTs. Okay, then cost analysis and strategic functions. So what is a cost analysis? What is a cost analysis? Means cost analysis examining the relationship between costs and business decisions. So that managers can utilize the resources properly and allocate the resources and get the maximum profit. So key determinants, what one is determine the optical production level, then supporting pricing strategies, then enhance the cost control mechanism and facilitate profit planning. Okay, types of cost in decision making. One is fixed cost, variable cost, total cost, average cost, marginal cost, and opportunity cost. So these are the cost. What when they are asking what is the types of cost, you have to write fixed cost, variable cost, total cost, average cost, marginal cost, and opportunity cost. So I can, because due to time non-availability, just I am reading. Just go through the PPTs which I am going to upload in your app. Okay, then additional cost concept. One is explicit implicit cost, incremental cost, sunk cost, then short run cost. What is explicit implicit cost? It is a explicit cost means actual cash uh, outflows, wages, rent. That is the explicit cost. Implicit cost, this is also called opportunity cost, owned by resources, owners time, owners capital, that is implicit cost. Whereas incremental cost, so changes in total cost resulting from a specific managerial decision, such as launching a new product line or expanding capacity. Then sunk cost, that means past cost that cannot be recovered and should not influence the future decisions. For example, R&D expenses, absolute equipment, etc. That is called sunk cost. What is short run cost? It is a period where at least one factor is fixed. Firms adjust variable inputs only relevant to immediately production decision. So long run costs are all factors are variable. Firms can adjust plant size, capacity, critical for strategic planning and expansion. This is the additional cost concept. Whereas short run averages, okay, these are thing, falling AC, okay, average cost, minimize average cost, then rising average cost. Just go through this one. Then long run average cost. Okay, one is economic scale. Economic scale is what? Long run average cost as output increase due to specialization, bulk purchasing, technical efficiency, the economic scales, whereas constant return. So long run average cost remains constant. Proportional increases in input leads to proportional increase in output. Then diseconomics to scale, that is that uh, lack, that is a long run average cost rises due to coordination of problems, bureaucracy, managerial inefficiency, etc. in very large. So these are the long run average cost curves. Remember economic scale, constant return, and diseconomics of scale. So production function frames. Okay, one is definition and significance you have to write. So production function shows that maximum output up obtainable from given input combination. So q equal to f into LKM, whereas Q is output, L is labor, K for capital, M for material. Short run production, at least one input is fixed, typically capital. Firm varies to labor change output governed by law variable proportion. So long run production, all inputs are variable. Firms can change plant size and technology characterized by return to scale. So a production function framework, increasing return, diminishing return, negative return. In the this is the same thing. Let me give you one example. Initially, any form, okay, so which in the any form, the here the production increases like this, then it become the increasing rate may be slow, then it becomes stagnant, then it become down. So like this, it happened like this. Okay, U shape may happen. Initially it is increases, then it diminishes, then it gives the negative returns. This is the production function framework. Okay, then we'll check here. Kindly be online. Here types of production function. One is a linear production, a second is the quadratic production, third one is cubic production, fourth one is a power production function, then sixth one is a Coburg Douglas. So just remember these are types of production functions. Just have this. Okay, then managerial application, how this production things applicable. One is they will take the output decisions. Okay, then cost minimization, they want to reduce the cost. Then resource allocation, what the resource need to be allocated. Then capacity planning, these are the managerial applications. Okay, so what we have learned in this particular third unit: cost concepts, cost behavior, production analysis, and managerial strategies. Okay, then we'll go for other unit, fourth unit. Okay, this is the, like what I am telling is one class which gives the one idea. Okay, so we'll check about the market analysis. This is the fourth unit. Okay, market analysis. Okay, understand the competitive structures and pricing strategies in modern market. So introduction to market in the market we analyze the competitors. Okay, it also analyze the how to operate, pricing strategy, what. Okay, what is the entry problems, how to be a strategic behavior in the market. It says about the market analysis. So market structure, number of firms and their role, their relative roles, that means number of companies in a market and their relative roles related to the company. Pricing power, so how one can influence the market by using price increasing or decreasing. Then entry barriers, obstacles, is there any issues in a new competition, that says about the market analysis. Okay, then structures of competition. So the competitions are four types. One is perfect competition, monopolistic competition, oligopoly competition, then monopoly. So perfect competition means many firms, homogeneous products. Monopolistic competition, many firms but differentiated products. Oligopoly, only few firms, strategic interdependence. Monopoly, single firm, unique product. So market ranges from perfect competition with the numerous firm to monopoly with a single dominant player. Such structures determine the pricing, behavior, and market efficiency. We'll see what is perfect competition and all. Perfect competition means there are many buyers and sellers. So no single entity can influence the market price. Homogeneous product, they sell similar products. Okay, no differentiation. So easy to entry and exit. Okay, there is no issue. Then perfect information, all the participants have the complete information about the market things. So example, in agriculture commodities like wheat and rice in Indian mandis, appropriately perfect competition. So this perfect competition means you have to write these points. Okay, then what is monopoly? Its consequences. What happens? Monopoly means only single seller is there, so one firm control the entire market supply. Price maker, so monopolists make the price of the product. Okay, higher barriers, so due to legal problems, due to technical, due to economical obstacles, so other people cannot entry. These are the monopoly and its consequences. So what is the negative consequences in monopoly? Higher prices and reduced output, consumer exploitation and dead weight loss, lack of innovation and efficiency. So wealth transfer from consumer to the monopolist. For example, Indian Railway, only it is not privatized, it is monopoly. It is related to the government. Okay, you have tried this. What is oligopoly and monopolistic competition? Oligopoly means only few firms are there which decide the market. Okay, for example, in telecom, you only Airtel, Jio, and VI. Okay, these are the three competition. In automobile, Maruti, Hyundai, Tata. Okay, so because oligopoly means very large firms which dominate the market, and they are interdependent. So firms consider rival reaction before making decisions. So high entry barriers because of investment. Products may be similarly or little bit different. Prices may be different or non-price competition. Monopolistic competition, what? Many firms sell the different products with the some pricing price. So combining the elements both the competition and monopoly. So product differentiation through branding, relatively free entry and exit, non-pricing competition through advertising. For example, restaurants, retail clothing, okay, personal care products. These are the monopolistic competition. Whereas oligopoly competition is the telecom industry and automobile industry. In telecom industry, we have Airtel, Jio, and VI. Whereas automobile, Maruti, Hyundai, Tata. Then price determinants. So this is a small presentation. A perfect competition. What happens? This is the price level output. See, the prices is way less, the output like demand supply is more. Okay, whereas monopolistic, so price is high, almost output also high. Price is similar. Say oligopoly is similar, then monopolist something like this. Okay, then we'll go to pricing methods and government intervention. So when they ask what is the pricing methods, it's the government intervention. One is a dual pricing, so different pricing for domestic and export market. Okay, so used to capture consumer surplus and maximum revenue across segment. There are two prices are there, one is domestic price and then one is the export price. Then administrative pricing, so this price is controlled by the government in the form of taxes and all the stuff. Subsidize, so in order to reduce the consumer prices, government gives the some subsidies, so common in agriculture, fuel, and essential commodities in India. The pricing methods and government intervention: one is dual pricing, administrative pricing, and subsidized. Then emerging marketing trends. So basically in monopolistic competition, one is brand competition, then consumer preference, then technology and e-commerce. So they are concentrate oligopoly. As I said, Reliance Geo and the Reliance like Airtel and VI, they are the oligopoly. They concentrate 70% of the market in their hand, and only 5 to 7% people are players are in there. Okay, these are thing. And technology new trends. What one is brand differentiation, so companies create their own identity through different marketing and innovation strategies. Then consumer preference, so consumers preference are changing. Okay, then technology and e-commerce, so digital things, online shopping, everything getting targeted. Okay, so nowadays mm, in fifth unit, like fourth unit, market mergers and acquisition impact. So nowadays everything get merged. Okay, for example, Maruti Suzuki. Okay, like that they tie up with other things, market consolidation, so reduce the competition, increase the concentration. If the two companies are merged or acquisition, the market may be uh, like the competition will be reduced and they'll get the good profits. Then global expansion, for example, if you want to tie up with the other companies, other global things, you have to tie up with the international market resources. Then economic scale, so you will get the cost advantages through the large operation. For example, the mergers or acquisition, best example is the Vodafone Idea merger, VI, Walmart, Flipkart. Okay, it is there in Karimnagar. Okay, Tata and Air India. These are the mergers and acquisitions and impact. I'm not going detail because it is a rapid revision class. Okay, so this is the thing. I'll check the other like fifth unit. We'll check the fifth unit. Kindly be online. This is the fifth unit. Okay, it says about the profit analysis, understanding the profit dynamics and strategies in a business decision and sustainable growth and competitive market. So what is profit analysis? So systematic examination of profit generation, measurement, and utilization of informed managerial decisions and organizational control. So it says about that performance valuation. So access the business efficiency. It guides the strategic planning and resource allocations. Okay, this is a profit analysis. Nature and significance of profit. There is three types of profits here. One is profit analysis there, residual income, business sustainability, and performance indicator. So residual income means profit represents surplus remaining after the deducting all the total revenues, the reward entrepreneur and risk taking. For the risk taking, the entrepreneur going to have the residual income. Then business sustainability. So in order to ensure the long term survival of the business, in order to expand the business, in order to attract the investors, the provision is given. Okay, so they'll get the profit for the sustainability. Also performance indicator, so the profit indicates the managerial efficiency, operational effectiveness, and competitive positioning in the marketplace. Okay, theories of profit. One is risk theory, uncertain bearing theory, innovation theory, and dynamic theory. When they are asking the exam, you have to write this. One is risk theory, uncertain bearing theory, innovative theory, dynamic theory. What is risk taking? So profit comes by taking the risk for so they have the calculated risk like market fluctuation, competition. Uncertain bearing, so this is also called as Knight's theory. So profits rewarding rewards for the handling in unpredictable or non-insurable uncertain behind the normal risk, that is uncertain bearings. Then innovation theory, which is given by the Scumpeter view, So profits arises from the introducing the new products, process or marketing strategies. Then dynamic theory. It is a Clark's theory. So profit emergence from continuous economic changes and market disequilibrium condition. So what is a profit theories of profit? You have to write risk theory, uncertain bearing theory, then innovation theory, then dynamics theory. So functions of profit. What is the functions of a profit? So once you get the profit, it's going to be resource allocation. So direct capital towards a profitable venture. Innovation drivers. So if you get the profit, you're going to get the more innovation things and motivate research and development. So it indicates efficiency, and if you already taken the risk, that is the reason it is a reward for you. Then growing finance. So profit says that you can expand your business. The functions of a profit is that resource allocation, then innovation driver, efficiency indicator, and risk competition, growth finance. Okay. So profit ending versus what is profiteering. Okay, I already asked in internals. So what is profit? It is a aspect profit earning and profiteering. Nature, legitimate business reward. Profit earning is a reward for the business, whereas profiteering unethically excessive gains. Okay, you understand, unethically means not ethical thing. So the profit earning is through fair pricing, value creation, whereas profiteering through exploitation, artificial scarcity, sustainability. It is going to be focused long term, whereas profiteering, it is a short term opportunism. So stakeholder impact, win-win for all the parties, whereas consumer is exploited in profiteering. Then legal status, it is a socially accepted profit earning, whereas profiteering often illegal or immoral. Example, competitive pricing strategy, whereas hoarding during the crisis. So these are the things. So ethical profit earning builds a sustainable business. Profiteering damage the reputation and invites the regulatory action. So profit control and decision making. How to control profits and decision making. Okay, profit like performance monitoring. So you have to track the each and every department product line profitability, and you have to identify the what the strengths and weaknesses. Then strategic decisions. So you have to guide pricing, investment expansion, and investment choices based on profits. Budgetary control. So it sets the profit targets, compare it to actual, implement the corrective action promptly. So dew point control chart. Okay, it is the dew point components. Okay, whereas profit margin and asset turnover. Then diverse sales cost, current fixed assets, ROI, return on investment, core metrics. So this is the thing. Just like return on investment, this is the formula: net profit by total asset. Okay, equal to net profit by sales into sales by total assets. Okay, profit margin, net profit divided by sales. Okay, asset turnover, sales divided by total assets. Okay, so this is the due dew point model decomposes a rate of investment, profitability, and efficiency component enabling the targeted performance improvement. So these are the concept, okay, of national income. One is GDP. It is the total value of goods and services produced within the domestic territory. GNP, which is the GDP plus net factor income from abroad. NNP, GNP minus that is depreciation. Okay, personal income, income received by individual before direct tax. Disposable income, personal income minus direct taxes. Just go through this. Okay, so how the business cycle happens. First, in the initial stage, the boom space. In the initial stage, everything is going to be increased. Your high demand, maximum profit, full capacity utilization, the rising prices. Then recession, continuously it decreases. So declining the sales, falling profits, innovation, accumulation, and cost thing. Then depression, it what happens? Minimum profits or losses, low demand, Okay, unemployment, business failure, this is called depression. Then recovery, slowly recovers, getting the smaller profit, improvement, increasing demand, and renewed investment and confidence. These are the business cycle and profit impact. Just remember this, that will be yield good marks. So this is about the small presentation from my side. Okay, just go through this particular thing, okay, which will be helpful to you to score good marks. Thank you. All the best for your examination.